Welcome to the Mills Knows Bills podcast. My name is Mills Bender. I'm the founder and CEO of Mills Knows Bills, where we help you, variable income earners, master your money in 90 days. The point of this podcast is to help you make the most of your fluctuating income so you can stop living paycheck to paycheck, pay off your debt twice as fast, and get on track toward reaching both your personal and professional financial goals. Now, as I continue to grow my team here at MKB, you may have some guest hosts from time to time. However, our goal does not change. Whether we're bringing in a guest speaker, having an in-depth conversation about our personal finances, or talking about a topic that is of interest to you, our goal is to help you master your money. Hello, everybody, and welcome back to another episode of the Mills Knows Bills podcast. I'm your host, as well as founder and CEO of Mills Knows Bills, Mills Bender. I hope that y'all have been enjoying this series that we've been putting together so far with burning financial questions meant for Vin Henrys. With us today, we have a special guest named Shawn. Shawn's going to take a moment, introduce himself, and then we're going to dive right into his burning financial question. So Shawn, please tell the audience a little bit about yourself.
Thank you, Mills. Yeah, my name is Shawn Lane, and I'm the CEO and founder of FRS Credit. We are a credit repair company. We help people improve their credit report and their credit score so that they can do things in life. Low credit scores hold a lot of people back from achieving their goals. And so, we're here to help them get back on track and get their credit improved.
I love it. I'm excited to have you on here today because, as many people know, I don't do personal credit repairs. And I know that everybody has their own zone of genius. So it's a great opportunity for us both to be chatting here today. What is your burning financial question you have for me?
Yeah, so as part of, my business, we look at a lot of credit reports. And, we've probably all heard on the news that, consumer debt now has topped, or credit card debt has topped $1 trillion. And so, credit card debt is a big problem for people. It's the most expensive debt that you can have. So, my question for you is, if somebody is buried in credit card debt, should they be investing, in their future for retirement, right? Because, we all know that, we need to be doing that. But at the same time, when we are paying, 25, 30% interest on credit card debt, it seems, practically that it would be better to focus on paying that down. But, one of the things I see is that people don't ever get around to, saving for retirement. So that I can better guide my clients, I would love to hear your answer. Should people invest in retirement if they have a lot of, credit card debt?
I absolutely love this question. And I actually go against a lot of other very famous financial gurus out there by saying, yes. That's the short answer. Yes, you should be doing both. So okay. I get asked all the time, emergency fund, debt payoff, or investing. What should I focus my efforts on? It's not a all or nothing response. You can do a little bit of all three of those. And as you cross items off the list, refocus and repivot your finances to the areas that then need to have a little bit more weight to them. So let's start with the debt payoff, since I know that you do with credit repair. What I always talk about with my clients is to come up with a debt payoff strategy, where I personally like the debt stacking method. You target the debt with the highest interest rate first and then work your way down rather than the lowest balance. So if you know the minimums across all of your debt payments and you can afford an additional $25 a month at least, take that full $25 and stack that on top of the debt with the highest interest rate first while maintaining the minimums of every other debt. Once that first debt is paid off, take that minimum plus the 25 and stack it on top of the next debt. So you have a structured game plan where you're working on paying off your debt. Might not be the fastest thing in the world, but at least you have a game plan.
in the meantime, they get to work with somebody like you to continue repairing their credit, whether that could be negotiating lower interest rates with their lenders, asking for a break on their credit cards where maybe they don't get to use the credit card, but they're on a structured payment plan, maybe transferring some of that debt to a zero balance transfer card, whatever it may be. So that way they can have that strategy, but it also gives them the ability to put some of their cash flow towards their saving and investment strategies. Let's talk about saving first. You need to have an emergency fund. And an emergency fund is 3 to 9 months of your mandatory living expenses. So mandatory being living plus your minimum debt payments. So you need to work towards putting some of your cash flow towards your savings, because if you know what hits the fan and you don't have any savings set aside, how are you going to cover that unforeseen expense? You're going to put it right back on that credit card that you just paid off. And that's infuriating. So you need to give yourself some of that insurance on the savings side so that way you can maintain that debt payoff strategy. And now getting to that final component, which was really the point of your question, is investing, right? How can I make sure that I'm still investing for my future? Time is on your side. For every 10 years you wait to start investing, it's going to cost you 3 times as much to get to the same end result. So put $25 a month, if you can, towards your financial future. Let that work on your behalf. Once your debt payoff is done or your emergency fund is done, you get to reestablish that cash flow towards the investing instead. But if you don't have this structured plan where you're working with everything in tandem, you're doing your future self a financial disservice. And I know you being in credit repair and looking at different interest rates all the time, some of my favorite things to look at is anything that's greater than 10% on the debt side should 1,000% be paid off. Anything that's less than 10%, it depends on inflation. So between 10% and inflation rate is really dependent upon the consumer. Anything less than the current rate of inflation, in my opinion, I don't pay it off. If anything, I take the extra I would have put towards it and just invest it, because you can get higher rates of return investing in the stock market than you can paying off something that's 2%. Does that make sense?
Right. Okay. Mm-hmm. So can I ask a follow-along question?
Yes, absolutely.
Okay. So, so the individual that has, a lot of credit card debt, I'm talking, $80,000 to $150,000 of credit card debt, because, I do see that all the time. If that person owns a house and they have equity in their house, would you recommend that they make the tough call and go ahead and, sell that house? If they can't do a cash out refinance, sell that house to get out of debt and then kind of start over.
Have they already explored the options of working with the lenders directly or maybe doing the 0% balance transfer cards?
Yeah, so a lot of times when somebody is heavily utilized on their credit cards, those minimum payments impact their debt to income, and so they can't qualify for any sort of cash out refinance, home equity line of credit or what have you. So they can't even qualify for the loan that they need to go ahead and, pay down those cards. And so, a tough call is, well, maybe you should sell the house and pay those off, but you can't get into the position where those credit cards start inching back up on you. You have to become responsible and not spend the money that you don't have.
Yeah, and that's kind of the $1 million question is, do you have the discipline to make sure that you don't put yourself in that position again? Face value, I kind of view cash out refis, HELOCs, and selling the home to pay down other debt as an absolute last resort. And the reason why is because you're taking unsecured debt and you're making it secured. Now, looking at the finances, if you're in a situation where it does make sense for you financially and you have established the discipline to make sure that you get back on track with your finances in the future, it could be a really good option for somebody. But that's not a decision that I would make lightly, kind of like cashing out a 401k. I would explore
Right.
all other options possible. But sometimes if that's the only option, that's what they got to do.
Yeah.
That's
Great.
a hard one. It's a case by case scenario.
Yeah, and I think one of the things is, do they have the earning potential to actually pay off those credit cards,
Yeah.
or do they not see advancement in their, career, or if they're, self-employed or own a business, if they don't see the growth opportunity in their business to dig out of that debt, then, maybe that would be, a solution.
I mean, if somebody is considering selling their home to pay off their debt, while they're exploring all of their options, I would even encourage them to explore talking with a bankruptcy attorney. Because if your back is that far against the wall, they might be able to refer you to somebody in debt consolidation, or maybe bankruptcy is the right solution for them if they don't have anything else, like you mentioned, like increased earning potential or cash flow. I mean, sometimes life happens and maybe somebody died, the breadwinner, and they don't know what to do with the rest of their debt. There's a plethora of different options out there. And I don't throw out selling your home or bankruptcy attorneys as the first solution. But if you're considering one, you should probably consider the other before you make a decision.
Okay, great.
Good stuff. So
Awesome. Well, I appreciate that.
of course, my pleasure. And so you do credit repair. Tell me more about the perfect client for you.
So, we've been in business for 11 years, and, a couple things that I have learned being in this business is that a very large percentage of people have at least one derogatory mark on their credit report that's impacting their credit scores. And then obviously some more than others. And so people tend to know that they have bad credit, but they don't do anything about it typically until they reach enough pain in their life. And so, the ideal client for me historically has been the person wanting to buy a house, right? Because they've come to that conclusion that they're tired of renting. Maybe they've met their future spouse, and they're going to get married, and they want to start a family, and so they want to buy a house. Well, for me, that is a motivated individual because they have a goal. People don't buy credit repair. People buy a solution to the problem that they have. And, unfortunately, people learn to live with bad credit. I see 20 to 22% auto loans on people's credit reports, which is insane, but it's because they have low credit scores. They might have a repo, or something like that. And so, that's why, I like to call our credit score, it's our adult GPA. It is our grade point average. So many things we do financially have a credit score component, including the cost of our insurance, is heavily driven by our credit scores. And so, I like that client who's been turned down for something, whether that's a mortgage, maybe it's an automobile client who's finally tired of paying those high interest rates. Perhaps a business owner that's looking to, get some business financing. Those are ideal clients for me because, as I mentioned, lots of people could use my services, but they have to, have a reason, unfortunately.
Yeah. So, I mean, it sounds like somebody should not wait until they have a reason to reach out to you. This should be more proactive.
Absolutely. And that's, I do a lot of education centered around credit. And one of the things that I talk about is people need to be monitoring their credit. And it is great that our credit cards or our bank, give us a credit score. But we need to understand that's one score from one credit bureau. So we need to have some solution for monitoring our credit for all three of the major credit bureaus, because in the world we live in today with identity theft and data breaches and the confusion around medical debt and how insurance takes forever to pay it, collection accounts and things show up on people's credit reports and it impacts their credit. So just because you had good credit the last time you did a major purchase doesn't mean that you still do. And so people need to monitor their credit so that if something comes up on their credit report, they can be proactive, like you said. They can be working to resolve that issue as opposed to waiting until their back is against a wall and they need to buy a house or they need to buy a new vehicle. So people need to, if they're not already doing so, they need to be checking and monitoring their credit report.
I love that.
For sure.
So if somebody listening or watching to this episode either is in a situation where they need a solution ASAP, they would like to be proactive, they know something is derogatory on their credit report and they want to work towards improving it before they need the solution immediately. Or maybe you're in a situation that you're not really sure where your credit is at. You're in that situation where Shawn said, maybe last time you purchased something, it was totally fine, but you're not sure where you're at right now because you don't know how to look up your credit report or you would like another person to take a look at it. Please reach out to Shawn. Let him guide you through that process, regardless of which of those three buckets you're in. And so, Shawn, how can somebody contact you? What's the best method?
The best method is our website, FRScredit.com. On our website, they can book a call with myself or one of my credit consultants. They can either book just an informational short call just to find out a little bit more about what we do, or they can book a full credit analysis. And we'll look at their credit report for free. We'll have them on our website. There's a credit monitoring link where they can go get a current up-to-date credit report from all three credit bureaus for just $1. And it's a soft credit pull, so it doesn't impact them, but they can order that report, book a call with us, and then we're happy to do a full credit analysis and let them know where they are. We look at credit reports all day long, and sometimes it's somebody that needs our services. Sometimes they just need some solid advice, and we're happy to review their credit report. No obligation to start any sort of service with us. We just want to be able to help them, let them know where they are, what type of things they can do to, improve their credit or keep it strong if they already have good credit.
Perfect. Thank you so much. I really appreciate you taking time out of your day. If you would like to take advantage of Shawn's offer, please visit the show notes below. Make sure you click on that link, schedule that consultation, or even take advantage of that $1 soft credit pool. Shawn, I hope you have an amazing rest of your day, and I look forward to seeing you soon.
If you stuck around long enough to get to this part of the podcast, I just want to say thank you. We really appreciate the fact that you take the time to listen to the content in its entirety, because we do pour our hearts and soul into every single piece of content we let out. So thank you for being here. I want to let you know that if you're in a space where you're trying to level up your finances, you can always snag some free resources on our YouTube channel, Instagram. You're always welcome to email us at info@millsknowsbills.com. And if you're interested in taking part of any of our coaching programs or courses, be sure to mention our podcast to get a special discount, okay? We want to make sure that you are making the most of your financial investment. Again, I am your host, Mills Bender, founder and CEO of Mills Knows Bills. Thank you so much for listening. And just because I gotta, here's a quick little disclaimer. I want to remind you that this podcast is strictly discussion, okay? It's general, it's educational in nature. We don't provide any specific tax, investment, legal, or financial advice on this podcast with respect to any particular individual, okay? So if you're in a situation where you need specific help, please consult your own advisor regarding your unique situation, because it's not a one-size-fits-all.